Hey, how you guys doing? It's Modest Phillips. I want to first off start by saying thank you guys for making it to the first video in this training. I really appreciate you taking your time out to actually see what this was about. Or if you already know what it's about, then it's pretty much like some extra information for you. So this first video is basically going to be based around the very basics. It's for people who might not even know what Forex is, to actually like show them what it is, to show you what it is, and see if you can apply that to your life and see if it can work for you. Or, you know, maybe it doesn't work for you. But you'll be able to judge that by the time you get done with this series. So we're going to jump right into it because I know it's going to be probably like an hour-long video or somewhere within there. So I don't want to stand it too long because the later videos will be a little bit longer. First off, what we do is we trade the Forex market, right? And what is Forex trading? The foreign exchange currency or FX, whatever market is this wherever one currency is traded for another. This is by far the largest financial market in the world and includes trading between large banks, central banks, currency speculators, multinational corporation, governments, and other financial markets and institutions, right? So the average daily trade in the global Forex markets currently exceeds around 2 trillion retail traders, individuals, or mostly of the market that make up the market. So what is traded in Forex trading? Like a lot of people say, what do you trade? Like what are you actually trading to make money? So the answer is currencies, right? Currencies are always traded in pairs, such as Euro USD, which is the euro. It represents the euro currency, and USD obviously is the dollar, right? GBP, which is the pound, which represent Great Britain currency, and again, the dollar. So when you trade Forex, you basically are exchanging one currency to another currency simultaneously, buying one currency and selling the other at the same instance. You will gain from differences of the traded currency price rates, meaning like you'd be buying euro against the dollar, or you'd be selling euro against the dollar, right? And you'll be making your money by the difference of that if you're doing it in the correct direction. Because in the Forex market, when we're trading, we can trade up or down. Like we can buy or sell, and that's what's so amazing about it. And it's like some limits in some other markets, and that's why so many people are attracted to the Forex market, because it's a large volume, as you see, and because of the ability to be able to trade up and down. So a few quick examples, that's just trade groups, but a few quick examples is like when you hear somebody say buy Euro USD, or when you're buying Euro USD, that means you are buying Euro and at the same time you're selling USD, like they were saying up there. I might have to turn, nah. Sell Euro USD mean that you are selling Euro and at the same time buying USD. A currency pair depicts a quotation of two different currencies. The first currency in the pair is the base currency. The second currency in the pair is labeled quote currency or counter currency. Then you'll hear more used as quote currency. So that means the Euro side of it is the base currency, and the USD side of it is a quote currency. No matter what pair it is, it'd be the same thing. The leading pair is the base currency, and on the right is the quote currency. So such a quotation depicts how many units of a counter currency are needed to buy one unit of the base currency, right? So it'd be like, how many USD do you need to buy Euro, right? So current Forex quote displays GBP USD at 1.8500. That's the prices at, right? This means to buy 1 pound of GBP, you need 1.85 USD, right? So another example for the quotation would be Euro USD and be the same thing. While the Euro is the base currency and the Euro is the quote currency, it'd mean to buy one Euro at 1.25, you would need $1.25 of USD. So it means that Euro is exchanged for 1.25 of the US dollar. If the quote moves from 1.25 to 1.2510, then that means the Euro is getting stronger and the dollar is getting weaker. On the other hand, if the Euro USD quote moves from from 125 and it moves down below that, then that means that the euro is getting weaker while the dollar is getting stronger, right? So it's real simple. Like as you see, like you got the pairs Euro USD. Let me actually do this so we can all be on the same page. So you got the pair Euro USD. The price chart is moving upwards. Euro is the base pair, right? USD is the counter pair. Remember, base, counter pair, meaning quote currency, base currency, right? So if it's moving up, that means the euro is getting stronger than the dollar. So that means the dollar's going weak and the euro's getting strong. So an exact opposite for the opposite side, like if this is getting weak, then the dollar will be getting stronger, right? So now let's talk about the pairs. Like you have different multiple different pairs that you can trade in the market, but there are certain pairs that people trade more of, and it all depends on what you want to do. But majority of people trading in Forex are trading the major pairs, which are Euro USD, GBP USD, USD JPY, USD CHF, AUD USD, and USD CAD. So right here is a chart of just what the pair is USD, what country is the currency for, what the pair is the dollar, and the nickname of it, which is multiple different nicknames. So you got like the USD, the euro, the Japanese yen, the British pound, the Swiss franc, the Canadian dollar, the Aussie, and then you got the New Zealand. So it showed like New Zealand, Australia, Canada, Switzerland, England, Japan, Euro, Union, and United States, right? These are the countries of these currencies. So these are the main countries, right, that moves moves the most volume in the market, right? So then you have, well, we'll get to that. I don't want to jump ahead. So although exchange rates are affected by many factors, in the end, currency prices are a result of supply and demand forces. Supply and demand factors are constantly shifting, and the price of one currency in relation to another shifts accordingly. No other market encompasses and distills as much of what is going on in the world at any given time in the foreign exchange market, because it's the actual affected by certain things that we're going to get into here. So supply and demand for any given currency and thus its value are not influenced by any single element, but rather by several. These elements generally fall into three categories. So you have economic factors. These include economic policy disseminated by government agencies and central banks, economic conditions generally revealed through economic reports and other economic indicators. Economic policy compromises government fiscal policy, budget spending practices, and monetary policy, which means by which a government central bank influences the supply and the cost of money, which is reflected by the level of interest rates. Which is stuff that you can get into later, like as you learn more about some more stuff that I'm going to teach you, but you'll understand more about this. So it's also could be affected by political conditions. Internal, regional, and international political conditions and events can have a profound effect on currency markets. For instance, political upheaval and instability can have a negative impact on the nation's economy. The rise of political faction that is perceived to be fiscally responsible can have the opposite effect. Also, events in one country in a region may actually spur positive and negative interest in the neighboring country, and the process affect its currency. So if it affects its currency, basically, or if any of this stuff that's happening in politics, all that different type of stuff, if it affects the country, then it's going to affect the currency, basically. Psychology. Market psychology and trader perceptions influence the foreign exchange market in a variety of ways. Flights to quality. Unsettling international events can lead to a flight to quality, with investors seeking a safe haven. There will be a greater demand, thus a higher price, for currencies perceived as stronger over their relatively weaker counterparts. Long-term trends. Its currency markets often move in visible long-term trends. Although currencies do not have an annual growing season like physical commodities, business cycles do make themselves felt. Cycle analysis looks at long-term and price trends that may rise from economic or political trends. Buy the rumor, sell the fact. This market truism can apply to many currency situations. It is the tendency for the price of a currency to reflect the impact of a particular action before it occurs. When the anticipated event comes to pass, react in exactly the opposite direction. This may also be referred to as a market being oversold or overbought. To buy the rumor or sell the fact can also be an example of the kind of bias known as anchoring. When investors focus too much on the relevance of outside events to currency prices. Then you have economic numbers. While economic numbers can certainly reflect economic policy, some reports and numbers take on a talisman-like effect, right? The number itself becomes important market psychology and may have an immediate impact on short-term market moves. So what to watch can change over time. In recent years, for example, money supply, employment, trade balance figures, and inflation numbers have all taken turns in the spotlight. So there are technical trading considerations. As in other markets, the accumulated price movements in a currency pair, like pairs such as like Euro USD, can form patterns that may be recognized and utilized by traders for the purpose of entering and exiting the market, leading to short-term fluctuations in price. Many traders study price charts in order to identify such patterns, right? So you like we use technical analysis. We use tools in technical analysis, like the tools you see up here, but they're not these tools, but we use tools like in technical analysis that helps us be able to formulate patterns and be able to get certain areas in the market where we can anticipate certain moves to be made. Like the beans that you steady hearing in this chat that you see popping up is from people who is making their technical analysis and they're giving their ideas. Hey, I think this is gonna happen, or I'm in this, or I'm making money in this, or I have to do this and change this, you know? So many traders, most traders study price charts. Some people look at the fundamental aspect. Some people don't even look at the fundamental aspect. Some people just look at the straight technical. I have a little bit of both. I'm no fundamental trader by far, but I do have a few fundamental things that I put into my analysis when I'm placing trades. So how, and just for people wondering, like when you're hearing about charts and technical analysis, on my YouTube channel, you're going to be able to subscribe and get to my YouTube channel. I'm going to be showing you how to, you know, with the charts and how to work the tools and this, all of that stuff. There's going to be plenty enough there. So, but this is more of like trying to break down and explain what is the actual entity of Forex is, right? So trading Forex is exchanging a currency to another currency to get benefit from changing price rates of a currency compared to the other one. For example, a trader made a profit by buying Great Britain pound. A trader buy GBP USD. So he purchased 10 lots of GBP with USD in the beginning of February in 2007, when it don't matter the date, just purposely, when GBP USD was at 1.980, right? So this is the Great Britain pound. He purchased 10 lots, US dollar, and moved 10, US dollar went negative, right? So, which is supposed to do. So the next day, the trader sells GBP back, and then a dollar goes, US dollar goes from 80 to 20. So what's that? 200. So with that, you make a profit of, see, 200. In this example, the trader earned a gross profit of 200. And that's how every transaction is made. And this is what Forex trading is. You're buying a currency against another currency, or you're selling a currency against another currency and hoping to make the differential. If that currency actually sells down and the other currency goes up, then you will make profit. Or if it does the opposite, then you won't make profit. So this is super, super important. This is something that you want to write down in your notes. It's so important to learn this, to know this. The Forex market schedule. Yes, the Forex market is open. You can be traded 24 hours a day and 5 days a week. The main trading centers are in London, New York, Tokyo, and Singapore, but banks throughout the world participate. The biggest foreign exchange trading centers is in London, followed by New York and Tokyo. Currency trading happens continuously throughout the day as the Asian trading session ends, the European session begins, and so on and so on and so on, excluding weekends. But just because the market is trading 24 hours a day and 5 days a week, that doesn't mean that you have to be in the market at those different times. We have, or people before us, and we've been able to see and use and utilize that there are certain times when there's more chance that you can be correct in the market because of the times that these sessions are actually going on. So, and that's the London session and the New York session, right? That's, and depending on the period, can be the Tokyo session, because it's obviously yen, Japanese, and this is obviously euro and GBP. It's obviously the US dollar, right? So that has a lot to do with it. And you want to, like, I'm in California at the moment, but all my time that I talk about is Eastern. Like, anytime you hear me give out a time in the training on the video, it's always going to be referred to as Eastern, because we go by New York Eastern time when it comes to our trading. Just have to throw that in there real quick. So a lot of people ask, why trade Forex, right? So let's give a couple reasons. Then I'll give you my own. These are some of my reasons, but then I'm gonna give you even like a more in-depth more reason. Forex has two ways opportunities. Unlike the stock market in Forex, you can earn profit from upward or downward price movement, like I said in the beginning, right? For example, if you buy, meaning go long meaning buying, right, and the price is moving upward, you will be in profit. And it's the other way. If you sell, go short meaning selling, right, and the price is moving downward, you will be in profit, right? So that's one of the most intriguing things about the Forex market. That's why I love it. That's why I have so much passion about Forex, because it's like, once I got into it, it was like when I was brought into it, it was like, okay, cool. And then as I stuck with it, it was like one of the first things ever in my life that I like just super stuck with it and was going 110% at it. And, you know, now it's to the point to where I'm able to be in a whole different totally aspect of life, be able to grow in other different areas too, not just financially, but also be able to grow as a person. And Forex helped me do that. And the people I met doing this helped me do that. So it's so much more than just, hey, can I make money in this? It's about the journey that it takes you to and the person that it evolves you into, right? So another reason is the long trading hours. Like I said, Forex allows you to trade 24 hours a day and 5 days a week, except on the weekends. Except if you're trading Bitcoin, you can trade 7 days a week now, but you don't have to trade all day. Like we said, it's opportune times. So another thing is high liquidity. Forex is the most liquid market in the world. And that means you can buy or sell anytime you want, as long as the market is open. So another thing you have to worry about is without middleman, right? Forex online trading involves no middleman. Traders execute their trades directly, and each decision is taken by the trader himself or herself. There is no dealing quotes intervention. So it's like if you pick, once you invest into trading, when you taking your trade, there's nobody else in the middle of you getting your money. Like, that's your decision, your trades. There's no middleman, right? So no possible market intervention. Forex market is the largest financial market in the world. It is impossible for any one entity to drive the market for any length of time, because it's so big. It's our money. It's the world's currencies. It's everything, you know? So it's like the money will always be circulating around. It's free of commission, right? Forex brokers usually charge no trade commissions and other trading fees. However, brokers get their compensations from spreads. And the spread is basically where you're taking the bid price and the trader is selling the price to the brokerage and the ask price, and the trader is buying that price from the brokerage. And you kind of subtract those on whatever it is that's your spread of the trade that you took. And when it's not like nothing crazy or nothing, so you don't have to be like, oh, no. Flexible lot sizes. Almost all Forex online brokers offer flexible lot sizes for traders, standard and mini lots. This allows individuals with small accounts or small traders with limited equity to place smaller trading values and still be able to get money. So, example, a trader with $500 equity is able to trade mini lots, and a mini lot has the value of $5,000 equity. So you don't have to have $5,000 to trade the volume like you had $5,000. It's like the leverage that the broker gives you allow you to have a $500 account and you can have the volume of $5,000. But there's more into it than that. You know, you get to learn about leverage and risk management and what to do and when to do it and when not to do it. We're going to learn more about that as we keep going into these slides. Trust me, it's going to get good. It's going to get live. So leverage trading volume, right? A trader does not need to have $100 to start trading one standard lot, right? A leverage function lets a trader to trade one standard lot volume of 100 units with only a small percentage. So for the people who still might understand what that means, just imagine this. Just imagine if you could take your $100, right? And you can go to the store and spend it like it was 1,000. Whoa. Drum roll. Yes, yes, yes. I know people salivating. I know they sliming at the mouth like, I need to know more about this. Well, don't worry. I got you. I got you. I got you. So keep in mind that the potential profit a trader earned is leverage, as it is calculated based on trading value. And this was one of the things that when I first got into trading, like kind of like just blew my mind, because I understood risk aversion because I was doing sales and stuff. And I understand it like risk reward. One second. So another beautiful thing about this is you have what you call demo accounts that you can practice Forex trading without risk. So with demo accounts is you have two different account types, right? You have what you call a live account and a demo account, right? You have a live account, you have a demo account. The purposes of a live account is real money. Like you're risking real money. You know, and the purpose of a demo account is that you can make an account and you can practice without risking real money. Think about it. Basketball, any profession, anything that's a profession that's considered a profession or anything that you do, you practice at it before you go out. Like soldiers don't go to war without training, or athletes don't practice or hone their skills before they go play in an actual game against real competition. So that's a blessing. And, you know, you get to practice, you get to learn before you actually risk your real money. You can start, you know, entering small amounts of your money. And as you get better and better, then you can invest more and you can invest more and you could potentially make more. So another big question is, and especially if you come into this not knowing what this is, I know this is a question that you have, and this is why this is here. What do you need to start trading Forex, right? One of the things that you're going to need is a personal computer. So a PC notebook is like the main device that most people use to start trading Forex online, because once again, it's online. Then once you get used to that, you can obviously trade on your phone. The same brokers that we use on our computers, we can download on our phone and place trades, or we can manage our trades, right? So what you must have stable and high-speed internet connection. I found that out the hard way when I was living in Texas. I actually was trading like a live account, and we was risking some money, me and one of my friends, and you know we was making like $600-700 in this trade that was in, right, in like a couple hours, and then the internet just froze for like a couple of minutes. We couldn't get nothing to work. I don't know why we didn't go for maybe we were just so panicking so much we couldn't even think. We were all doing crazy stuff. And before we know it, boom, it was all gone. We're negative 300 now. So, you know, even though at the end of it ended up turning out good, but that's just an example why you want to make sure that you got reliable internet. You do, man, I'm telling you. Limited fund, right? We strongly recommend that beginner traders to try demo accounts before using real money. Like I was saying, you want to practice before you actually get out of the real field. Reliable and trusted Forex brokerage. Trading at reliable and trusted Forex brokerages, meaning the people who you're going to be placing the money into to use their brokerage to place trades and analyze charts and stuff like that, to use technical analysis, do not easily come about, right? So there's many of them, but you just find the one that suits you. And usually when you get into this, you're going to be conversating with people who trade Forex, and they'll put you on a good broker. They'll tell you who's good and where you should go to. Do not easily be attracted to any promotional bonus without checking your broker's legal aspects and your broker's reputation. So don't be afraid to do some research on a broker that you're thinking about joining when you're ready to start trading your demo and live accounts. And it's free to join a brokerage. It doesn't cost. It's free. It's free to join a brokerage. So Forex quotes, right? The quotation of a currency pair usually consists of two prices, right? A bid and an ask price. The bid, usually lower than the ask price, is the price at which a market maker or brokerage is willing to buy the base currency, meaning the leading currency, right? The base currency in exchange for the quote currency. Or we could say the bid is the trader's selling price. The ask, usually higher than the bid, is the price at which the brokerage or market maker is willing to sell the base currency in exchange for the quote currency. So the conclusion is the bid is the price at which traders will get while he sells traders' selling prices. Ask offer is the price at which traders will get while he buys. Bid is usually lower than ask, and spread is the difference of bid and ask offer. The smaller the spread, the more profitable to traders, right? So how to read Forex quote. From the left image, you can see that GBP USD has bid 1.9899 and ask 1.9902, right? Or simply can be said 1.9902. So the spread of GBP USD above is 3 pips because you take the bid and the ask price and you subtract them, and whatever is left over, like the 3 pips, score 3 points, then that's the spread. So basically, if you enter a trade, you would have to pay the brokerage 3 pips before you can get it to profit, which is not a lot, as you're going to find out. So that's a fraction, man. That's like decimals of what you can make. If you open buy going long and buy with ask price, and you have to use bid price while selling it back. If you open sell going short, you sell with bid price, and you have to use the ask price while buying it back. See, this is the base currency, and this is the quote currency, right? So if you were buying this, then this would be the ask price that they want, right? They bidding it off to you for this, you know. And the accent this, and they bid it off for this. If you want to sell this, then they're like, hey, I will sell it to you for this, right? So buy long, you open with ask price, you close with the bid price. When you're selling, you're opening with the bid price and closing with the ask price. We're going to talk more about take profit and stop loss shortly. While we are buying, going along with X, we have to pay attention to bids at Forex quote tables, right? The bid must be higher than the X price we initially bought the price at, which we opened the position in order to earn profit. While we are selling, right, meaning going short with the bid, we have to pay attention to the X price at the Forex quote table, which is the bid price and the X price, right? So the high, low, open, close, right? So I'm gonna go to in one of my charts and explain this on an actual chart before we actually read the examples that they want to bless us with. So like basically what that's saying is you have the candle right here. This is a candlestick, right? So this is a platform that I use called TradingView. It's free. I use it to look at my data on the charts, and I place my trades on. I don't trade on this, but I use it to analyze my charts. And this is a candlestick chart, and these are candlesticks, Japanese candlesticks, which they show price, where is price at, based on a time basis, right? So each one of these candlesticks is worth whatever is an example of whatever, wherever time frame you own, how much time price action was made within that time period. So right now we're on a 1 hour chart. So that means each one of these candlesticks was 1 hour of price action. So if we're on a 4 hour chart, then that means each one of the candlesticks that you will see will be 4 hours worth of price action. And when they talk about come on, man, don't freeze on me. When they talk about high, low, open, close, when they're talking about a single candlestick has a low, right? It has a high, a open, and a close. So if you look at this candlestick here, the one you see my arrow point to, right? It's a down, it's a bearish, it's a down candlestick. So you have an opening price, you have a high, you have a closing price, and you have a low, where this bottom of this candle is at. But you can see it came down to. I'll zoom in a little bit to make sure that people can see. I want everybody to be on the same page. That's the goal here. See, like the bottom of this is like the low of the candle, the close, the open, and the high, right? So now let's go back to this and then to make more sense when we start talking about it. So the low will be the record of the lowest price reached at the time range from opening to the closing of a specific time frame. Example, for charts with the daily time frame, the low price means the lowest price of the corresponding daily chart. So the opening, the initial price, the opening of the initial price, not the high or the low, but the opening of the initial price of the candle, right? Of the specific time frame, it could be the 5-minute chart, the 15-minute chart, the 30-minute chart, it don't matter. It's the same on every chart. Then that's going to be the opening price. Same thing for the close. You have the opening and the close, you have the low and the high, right? It's totally different things, as I just showed you. Contract size, lot, contract size, and we're going to talk about pips. So when we're looking at the candlesticks, we say, hey, this thing went down 20 pips, or this thing went from 125 flat to 125.50, right? So it went up 50 pips. So what is a pip, right? A pip is a percentage in points. And what that means is that that's what we use to catalyze. Because I was reading somewhere and I thought it said something totally wrong. But that's what we use to determine what we're going to make or not make, right? By how many pips we're up or how many pips we're down. So and contract size lots is the smallest trading amount or whatever quantity for exchanging currencies. Meaning we use a lot size when we take trades. So that's how we able to determine how much money we want to risk for this trade, and we determine how many pips we want to try to make and how many pips we want to risk. So the common size are mini and standard lots. A standard lot is equal to 100,000 units in leverage, while mini is equal to 10,000 units in leverage. For example, a Forex broker offers you mini lot account. You can trade in incrementals of 10,000 units. For example, 20,000 units, 110,000 units, and so on. A Forex broker, which only supports standard lots, will allow you to trade incrementals of 100,000 units, 300,000, 100,000 units, and so on. So contract size and lot and value. One lot, 100,000 units, or AKA one standard lot. 0.1, 10,000 units, or AKA one mini lot. 0.01, 1,000 units, or AKA one micro lot. And this is what we're talking about with the pips. For example, if the quotation of Euro USD is 1.2025, a pip is represented by 0.0001. However, for a different currency such as USD JPY, 116.25, the pip will be 0.01, right? So in order to calculate the pip value or how much you will earn for one pip, you have to know some additional information as the contract size, the lot size, and the pair used, right? So it's a few things that go into that, which is so super easy. And we're, as you see, it's very, very, very simple to understand the difference between a micro lot, mini lot, and standard lot. For fractional Forex platforms, some currency pairs have one additional last decimal digit. For example, for major pairs like AUD USD, Euro CHF, Euro GBP, and so the ones you see. 1 point means 0.000110 instead of the usual 0.001. It's not confusing or nothing. You really don't. It's simple. If you know ones, tens, hundreds, thousands, it's so simple. This also applies for pairs involving JPY, which is less. Euro JPY instead of is 0.010 instead of the usual 0.01. So you may add 1-digit 0 at the back of the trading price for the pairs mentioned above. Example, buy GBP USD at 2.0005 with a take profit of 45 pips. In this case, you need to fill in 2.0050, right? At buy order price field and take profit. So that's what you would make 45 pips if it reached from 2.005 up to 2.0050, because that's 45 plus 5 is 50, right? So what are the definitions of long? So what are the definitions of longer open buys, meaning buying a currency with the expectations that it is sold at a higher price? So basically, when you're taking a long, you're buying the market up and you're in a bullish standpoint. You're saying, like, if I think that the market is going to go up, right? So I'm going to buy it. And if you're selling it, if you're going short, right? The definition of short is the opposite, that the market is going down and you're shorting the market, right? So an example would be this market going down here. Like when it's going down, that's short. When it's going up, that's going long. That's buying and selling. You obviously know down is selling and up is buying, right? So that's short, bears. That's all the different names for selling. And up is up, bulls, bullish, uptrend is going to heaven, skyrocketing, all type of stuff. You can use rocket ship, you know. It just means it's going up. That's it. So upward movement of currency pairs indicates base currency, or the pairs getting stronger than the current quote currency. So if you're looking at Euro USD, then that means that Euro, if it's going up, then the Euro is getting stronger than the dollar. And if you're looking at selling it, then that means, and if it's going down, the Euro is getting weaker than the actual dollar, and the Euro will be going down, going bearish, and the dollar will be going up, buying, going bullish. So the whole key to the market is you're looking for opportunities to buy and sell, because that's how we make our money. The market only doing 3 different things. It's either going up, it's going down, or it's consolidating, waiting to make another move, right? So it's no rocket science to the market, but there is techniques and it's strategy and it's a skill set. But the whole easy forefront of it is that you are buying a currency or you are selling a currency, and you're looking to make profits in a direction that you think is going to be going. So we don't have to keep talking about longer than shorten. So let's talk about market order, and we're gonna go to the charts a little bit too after we cover a couple more slides, because it's so important that you know these simple things, and this is what Forex is, and these are all the things you're gonna be using on a daily basis, and it's so simple to learn, especially when you have people around you who are willing to help you, willing to teach you, and want to see you win. So order types, market orders means order at the current market price. Opening a buy long position at market price, meaning the trader will open at the current action price. So whatever price they're axing at that current moment, if I go to my charts and I click buy, then I'm gonna buy it right there, whatever the action price. I want it right now, you know? So same thing, the opposite for shorting. You'll be selling it right at that price. Then you have, I want to actually go to, I want to pull up a whiteboard. And then you have this. And then, okay, let me explain it to you. So say this, you got, this is the market. This is what the market, this is the market baseline, right? And then you want to buy it. Market execution is if I click buy and it starts going up, it means I brought it here right at execution. Or if I sell it, I sold it right here at market execution. Next, you have what you call a buy limit or sell limit, which are basically orders that you can place in the market without having to be on the market to actually buy it when it's actually happening. So you're predetermining that the market is going to reach a certain area, and when it reaches there, if you're correct, then you can have these orders already placed to activate and execute you into the market. So for a buy limit, right? Say for instance, this was an area that you thought the market was going to go. You seen the market coming down, and you thought the market was going to reach this area. You can place a buy limit down here, and if the market reaches this area, it will activate you into an active trade. And then if it starts going up, you will make money. And you can already have your stop losses, how much you want to make, how much you want to risk, or where you want to get out at. And the same thing for a sell limit. If the market is coming up and you see an area that you think the market will reach and then reverse to the downside, like start selling, you can already have a sell limit up here, which is a pre-order that you don't have to click and activate yourself. It's based on that you already placed the order here based on a price that you think the market is going to reach. Like if this price is 1080, and you say, hey, the market is here right now at 108.50. I think it's going to get up to 108.80 and then start going down to keep selling, right? So before it even gets up to 108.80, I can place one of these limits here. And if it reaches there, I can be like sleep. I can be doing something else. I don't have to be watching the charts. You get what I'm saying? And it's going to put me in that trade, and I can have my stop loss set, like meaning that if it was to go against me, how much I'm willing to risk based on percentage of my total account based on this one trade. And I can already have how much I want to make. Like if it reaches a certain area, I'm like, hey, I want to get out of the trade here and take my profits and be happy. I can already have that preset along like this order, so you can just let the whole trade just play itself out, right? Because it might wiggle up in there and come down. That wouldn't matter because you will be able to have all that stuff already preset. So now let's talk about the next type of orders, which are buy stops and sell stops. The basis of a buy stop and sell stop is, say this is the market is down here and the market is trading up. And you anticipate that the market is going to trade up and keep going through this certain level, right? Say this level is 2.600, right? And you think the market is at 2.5770, right? So you think the market is going to trade up to 2.60, not reverse this time, but just keep going up. So you can place what you call a buy stop. It's the same concept as a limit. You don't have to manually be in front of your charts to do it. It's that when the market is going up, you can already have these orders already placed, and you can predetermine having your stop loss and take profits just like the limits. And you can automatically be put into the trade. If the market reaches that area, it will put you into the trade. And if it keeps going up, you'll make profit. And if it goes against you, you better have your protector stop. You better get out of the trade before you lose more money than you want. And when you make a certain amount of money that you're comfortable with making, or a certain area based off whatever you see that you want to take some money out, you can use that as a take profit that's already set. So that's the difference between market execution, which is taking the trade right there. Like I see the market right here and I want to sell it. I click sell and it's going to put me in a sale right there, versus a limit to where I predict that the market is going to reach a certain area and then reverse. If I see the market going up, I can put a limit there and not have to worry about it and predetermine my orders and setups. And an order, which is if I see the market coming up, I think it's going to reach a certain zone and continue in this trend that it's been going, which is up bullish, right? Then I can put an order to activate me into that trade and let me get on and participate if that was to continue moving up. So I really wanted to explain that because that's so important to understand, and that's the best way I know to explain it. So market order means order at the current market price. stop order or limit orders. Orders to open, buy, or sell only if the price is set is reached at that certain limit, right? So these are two type of orders: stop orders, limit orders, buy stops, buy limits, right? And we just explained that pretty like clearly. So let's talk a little bit more about leverage, right? Leverage is borrowed capital to increase potential returns. With leverage function, a trader does not have to deposit. Matter of fact, let me stop real quick. Let me show you an example. So say for instance, I assume that the market was going to come up to this point where I got this marker and continue trading up. I could put a buy stop right here while the market is at where it's at now. And I can put where I want to risk and where I want to, maybe I want to get out and here if it reaches here, I can already have that predetermined. So if the market was to trade up here, it would place me in that trade. And if it was to continue to go up, then it would be a good trade. And that's basically what all the limits and orders means. So now back to that slide. I'll just start to show a quick actual chart. Let's talk more about leverage. Leverage is borrowed capital. What is leverage? Leverage is borrowed capital to increase potential returns on the investment that you made with the broker. With leverage function, a trader does not have to deposit $10,000 in order to trade $10,000 worth of money. He can give $100, 1% of contract size, as good faith, basically like a down payment, as a deposit to trade $10,000 while trading at brokerage, which offers leverage of 1 to 100. Leverage is commonly available in ratio. Example, 1 to 50, 1 to 100, 1 to 250, 1 to 500, 1 to 1,000, you know? So imagine if another trader trades Forex without leverage. He must have at least $10,000 to trade one lot. At above scenarios, both traders have the same potential profit, but the first trader's margin required is a lot smaller than the second, meaning he got to have $10,000 and I can have $1,000 with, because I got more leverage, like I got 1 to 500 leverage, and I can use the same amount of lots that he's using. So it'd be like I have a $10,000 account and I can use that leverage to take trades. So conclusion, leverage makes a trader with small equity to have the same potential profits as traders with much bigger equity. So margin is good faith deposit required to open an order. Margin is temporarily held by brokerage until the order is closed, settled. Keep in mind that margin is held by your broker until the order is closed. Right after the position is liquidated, the margin will be credited back to your balance. So margin is quantified in percentages and affected by leverage offered by the Forex broker. Example, if your leverage is 1 to 100, that equals 1% margin requirement, right? So your leverage 1 to 150, that's 2% margin requirement, and so on. So let's say you got $1,000 cash in your account. To your broker with, if you got a broker that got a leverage of 1 to 100, the maximum contract lot size you can trade is almost 1 lot, right? So almost 100 times the balance, which is worth 100,000. It can be also be said that to trade 1 lot, 100,000, the broker needs 1% times 100,000 equals 1,000 worth of margin. So it's pretty simple. You see, they basically give us leverage to use to be able to be able to use more equity to place trades so we can participate in the market and we don't have to be those people who require to have $10,000 like how everything used to be. Your $100 margin will be blocked temporarily by your broker, and the rest of the 400 can be used to anticipate the loss that may occur, right? So $100 is going to be held by the broker, but you're going to have $400 extra. Like if it was to go negative, you would be able to hold it, or you'd be able to use more risk to take more because of the leverage that they give you, right? The benefit of leverage. A trader is able to trade much bigger contract size with a relative smaller fund, with or without leverage. A trader, equity, leverage, contract size, margin required margin requirement, profit, available margin, or whatever. Give me a second, man. I need to get some water. Take like a 2-minute break. Let's take a, it's 1:04, take a 2-minute break. All right, good. Okay. So a clear breakdown is like trader A, right? His equity, $3,000 means you got $3,000 in your account. You're using 1-to-1 leverage. Your contract size is 1,000. Your margin requirement is 1,000. Margin requirement percentage 100%. Means you have to cover that, right? So available margin is only 2,000. So you will get margin call quicker if you're trying to leverage more than if you had that same $3,000 account. You had 1-to-100 leverage. Your contract size would be 1,000, but your margin requirement will only be $10. Margin requirement, 1% of that 1,000 is what? $10. Profit, 0.01 pips. Available margin, almost 3,000, 29.90 to be exact. Almost 3,000 versus the 2,000 with way less leverage. So just imagine if you was using 1-to-500 leverage. Now, you have to remember, just because you're using higher leverage doesn't mean you're going to make profits. You have to still be right going up and down. So if you're using more equity, more leverage, you still can lose. You still can have negative trades. So you have to keep that in mind. And that's what the discipline and the risk management that you're going to learn about in later video series. So margin calculation. There are 3 groups of currency pair. Direct rates, currency pairs at which USD operate as the common currency. USD is located at the right side of the currency pair. Then there's indirect rates, which is USD operating as the base currency, like in USD is located at the left side of the currency pair, which is like USD JPY, USD CHF, USD CAD, right? And then you got what I call foreign currencies, which is currency pairs that don't involve nothing with the USD dollar. It's just like GBP JPY, Euro JPY, Euro GBP, NZD JPY, or whatever. That's the difference. You have the main, remember we talked about the main currency pairs that people trade are these, the direct rates and indirect rates. And then you got the cross rates, currency pairs which do not involve USD. So how to calculate margin of direct rates? You basically, you add the margin, you take the margin percentage and times the contract size, times the lot size that you use, and times the current price, and you can get your margin. So I'm gonna show you that on the charts, like more in detail. So let's go to the chart. No, let's do this slide first, and then we go to the chart, because it'll make more sense. So let's talk about real quick before we do is to take profit, stop loss, and trailing stop, right? Take profit is a target point at which you want to liquidate your position in profit automatically when the market price hits it, right? So I was talking about a take profit, like how I was saying, if we had the market going to, the market was coming up and we was in a trade and we thought it was going to come up to here, we can have a take profit set here. So when they get up here, we can get out of the trade and be done. So for a buy long position, the take profit level will be located above the opening price because you want to take profits. Or for a sell, it will be located below the opening price. And a stop loss, and I'm going to circle this because this is so important. A stop loss is in order to limit the potential losses if the market moves against the trader's position, aka your idea. If you bought here and thought the market was going here, but instead it went here, you need to know how much you want to risk if the trade that you're taking goes against you. And that goes in with your lot size, your account size, your risk management, your goals, your trading plan, and different stuff like that. So now, yeah, that's what I was looking for. For a sell, the stop loss is usually located above the opening price, and for a buy, it'd be located below, because if you're buying and they go against you, you want to like be protected, and if you're selling and they go against you by buying, you want to be protected. So stop loss can also be used to protect the profit you have, lock profit, in order to lock the profit you have already got. So meaning moving your stop loss and profit. So a quick example would be, say for instance, we're in a trade and it's going up, and then we think it's going to go all the way up here, and then it comes up here, and our stop loss is here. If it comes up here or wherever we choose, please, and it's going up there, we can move our stop loss from here. We can move our stop loss above the opening price to where if the market was to come down, meaning we wouldn't want to give it a chance to come all the way back down here, we'd rather get taken out here and lock in more profits versus getting took out here or losing money here when we were making money all the way up here. So why lose that money if the market comes all the way back down? So people have strategies, and it's based off your technical analysis that you'll learn. And that's going to help you be able to determine when you should be moving your stop losses and different stuff like that. But stop losses are so important, and moving your stop loss into profit and knowing when to is very important. And that's typically a trailing stop is an automatic of what I just showed you. So instead of you have to manually move it, you can kind of just set it up to where every amount of pips that it goes up in your direction, it'll move your stop loss higher and higher, so you'll lock in more and more profits in case the market just turns. Yes, it can be risky because, like you said, something can go wrong and then your computer froze and then the market is just moving and something don't happen. But that doesn't happen a lot, man. It's so rare. Yeah, it might happen to you a few times in your trading career, but if you stick to this and you be consistent and you work with the right people, trust me, the amount of money you'll be making, it'll be like the Starbucks or something. When the market, we don't need to do that. So in the margin call, what I was talking about was with the whole, if you are trading and you don't have enough to cover the trade that you're in, they will start closing your trades because you don't have the margin to cover the equity that you're trying to use. And you can't just do that. It just won't make sense. Like margin calls plays a role to protect traders' balance from falling to minus balance. Because if it just keep falling, like you'll owe the broker $600, right? So you need to get out of those trades before you owe the broker. There are two approaches used to determine margin call. Margin level. Margin level system is used at MetaTrader platform. Please try MetaTrader demo accounts in order to fully understand all that stuff. And I told you, I point you to my other videos that will show you how to get accounts and everything. So your free margin is free withdrawable margin while there are open positions. No, please leave enough margin to hold losses and prevent margin call, meaning that that's how much you have as total to operate in an account. Let's say a broker determines margin call by 5% margin level. If your equity margin times 5%, a margin call will happen, meaning the open positions immediately close one by one until your margin is back low enough to cover your losses. So meaning like if you need 5% of your margin to cover your losses, then it gets down into that, then it's going to close the trades until you have 5% in order to cover your losses. But you should be using, like, it's, you don't, that's, you have to know that, because yes, every week you can tell people to use risk management. You can tell people this and that. And everybody's we're human beings and we all try things, right? We all do things that we know we shouldn't be doing. So equity, use margin, and equity minus the use margin and plus the profit minus the loss equals that. There's another system that determines margin call based on the equity minus the use margin. The margin that you're using versus the full equity plus the profit minus the loss equals that, right? It's 100% margin level. And if you use a MetaTrader when it was margin used, then equity, then a margin call still happen, right? So example would be the trader's initial deposit is 300. He opened one mini lot on GBP USD. The margin required will be 10,000 mini lots times 0.02, leverage of 1/1500 times 2.0000, which is 40 bucks. So temporarily held by the broker is 40 bucks. So he have to have enough to cover losses without that 40 bucks. Interest swap rollovers. The interest traders may earn or be charged for holding positions more than one day. The Forex market calculates interest on a daily basis. At the end of each trading day at 5 p.m. New York time zone, traders will see the interest charge or interest income credited to their accounts. You will get it back. So when opening Forex transaction, the actual value date is 2 days forward. A deal which is done on Monday is for Wednesday. A deal done on Friday is for Tuesday's value, and Saturday and Sunday are not counted, and so on. So how to calculate swap? Traders will earn positive swap if the currency bought has greater swap rate than the borrowed one. Example, USD JPY. USD swap rate is 5.25%. The JPY swap rate is 0.5. Buy USD JPY means a trader is buying USD by borrowing JPY. Since you bought currency swap rates and USD is greater than the borrowed currency swap rate of JPY, the trader will earn interest, like you will earn money on that swap rate instead of lose money. And the Forex brokerage provides a list of daily swap rates for every currency pair available, and traders can find interest fees earning based on buy or sell positions they will trade. Swap is usually in money or pip values. These are examples of buys that people in, and it's the swaps that happen doing those trades. Actually, I want to talk about hedging because I don't use it. I don't want to teach it. Okay, so let me go over to the charts a little bit and spend about 5 minutes before we wrap up this webinar. Just explain a couple basic things. Let me reply to this message real quick, and we can go to the charts for about 5 minutes. Okay. Don't mind my, got some crazy people on my Facebook. I want to get this It's not the correct window. Yep, this is what I want. So let me clear out. This is ridiculous. Because I was actually, this is some lines I was marking for a different training video I was doing. So as soon as it loads, I'm gonna like just delete everything. Man, I wonder why it's moving so slow now. It wasn't like moving slow at first. Jesus, they don't want me to okay. Okay, cool. Just took a little second, I guess. All right, so I'm not going to go in depth in nothing, but like I was saying, like this, these are the tools that we use. We got different tools, like we got, we can click here and we can access like horizontal lines here we can draw on a chart that we might want to mark certain areas. We got different tools that we can use, like channels. We can make trend lines. We can use Fibonacci's, paintbrushes, markers, text boxes. We got extra tools for techniques that we use. And this is free. You can get this for free. You can determine long or short positions. It's just like all these tools help you be able to make technical analysis and put yourself in the best position to make trades and determine if you should be buying or selling, and potentially making profit on your idea that the market will be buying or selling. One thing, the last thing I want to end this video with is the market is real. The Forex market is real. People make real money. They risk real money. It requires real determination. It requires real focus. It requires real courage. You have to believe in yourself in this market. And that's a confluence of being around the right people, doing the right thing, being consistent with your studies, being consistent in what you're doing, becoming a better person, looking to grow, working on your mindset, and it's going to eventually show on the charts that you're doing what you need to be doing. So with that said, I'm going to end this video here. I don't want it to like stall out too long. And then in the second video, we're going to be more on the charts, and where we're going to do some more in-depth stuff. The first half of the video, be talking a little bit more about a couple more technical terms, and then we're going to go on the chart and see some of those technical terms. So thank you guys for coming to the video. I thank you guys for coming to the training. I hope you guys learned a lot. I hope you guys took notes. Please take notes, because as the videos go further, there will be call to actions and stuff that you guys can participate in. And with that said, once again, I'm Modest Phillips. I am the owner and co-founder of Royal Entourage Global. We are a network that helps people learn how to trade in the financial market. And also, we have multiple different other businesses that we do in other industries. Like we have a marketing consultant agency. We have carpet. We have a home repair business, different stuff like that. But this here is about us being able to share what we've been able to learn and tools we've been able to utilize that's been able to help us become successful. And this is why we're doing this. So thank you guys for coming. I appreciate it. I'm looking forward to seeing you in the next video. Rewatch this a couple times if you need to. If you need to ask questions, you can contact us on our Facebook page, and you can be able to follow our YouTube page, and it's going to have a lot of help videos on there as far as understanding what you need to be doing the first couple of steps, where you can start, and different stuff like that. So please have a beautiful day. I love you guys, and I'll see you in the next video.